Continuing with this thread of fresh perspectives, I now request Keshav sir to present his ideas and thoughts.
Good morning, everyone. First of all, I want to thank Member Financer for encouraging words, and I also want to thank President ICAI, Jambu Saria sir, for his great insights into how technology is getting involved with the accounting numbers. And there is also one more area where we as railways are getting more and more involved, and that is railways romance with markets. And we'll just talk about how is it going for railways. One of us have been tracking the listing of various stocks like IRAS, IRFC on the bourses, and many of us keenly observe how they move. The interactions with the market of railways have been maturing over a period of time. Although there are many companies like IRCON or RITES which had listed themselves much earlier, in fact Concor also for that case, but the recent listing of IRCTC and IRFC has again regenerated the interest in the public. And these two IPOs, which happened last year, have shown that how positively the railway companies are perceived by public and how much they like them. So the first mode of method is the equity markets, where we are going through IPOs or OFS. Second is debt instruments, are widely popular. IRFC's debt instruments, already as told by Member Finance, are generating low cost funds for railways projects, and they are highly successful in domestic markets as well as the foreign markets. In fact, it is something which we should be proud of, that we are today one of the few private NBFCs raising a lot of money domestically and globally. And third is the prospective InvITs. InvITs are nothing but infrastructure investment trust. They try to monetize, or they try to look for passive investors who come into the infrastructure projects with a decent amount of return. Most of the sovereign wealth funds like Abu Dhabi investment authorities are people who invest in such kind of InvITs. Already we see a lot of investment coming into Reliance InvITs. We have PGCL InvIT lined up. So InvITs can be a lot of a type of financial structure where we can try to unlock our investment and use it further. When such kind of scenario is emerging, when people are moving towards market, we are moving towards market instruments, debt is rising. Yes, people who think from the perspective of debt servicing with respect to the operating budget may think that debt is rising, our debt servicing payment is rising. So there are some common perceptions which are building internally as well as externally in the society and the organization. I have listed those common perceptions. One is railways moving into a debt trap. It is taking too much of debt. Railways is selling its companies cheap. Railways is government organization which does not need access to markets. Railways should raise finance internally. We all are emotional people. We are human beings, and we need to understand that the sentiments will come up when some changes like these happens. But we are also bureaucrats at the same time, and we are rational thinkers. Bureaucracy is all about rationality. We cannot let the sentiments overwhelm the rationality of a bureaucrat. And therefore, there is a need to scientifically evaluate these perceptions through the eyes of a finance manager. Now, the first thing we need to ask is whether we have the asset size, equity, and target debt to equity ratio of the railways. How do we say that we are going into debt trap? Have we measured the debt to equity ratio? What it is important is that we need to have these figures on the table before we can say that we are really moving towards debt trap, or actually we may be short of leverage. And if we have gone ahead of leverage, then do we need to deleverage? So all these phases of financing and investing and executing the projects have to be analyzed through numbers. Second is, yes, we are aware that IRFC's outstanding loan to railways is around 2.9 lakh crore approximately. This is the known figure to us, which can help us in understanding better how we are moving in this scenario. Third is, do we have the fair value of assets available? It is not only important to bring our assets onto the books, but we should also understand that if we need to extract the best price out of our resources, out of our assets, we need to have fair valuation done. And there are a number of valuation techniques available in the market, which we need to understand so that we do not miss out the opportunity and discount ourselves. Identification of value creators and value destroyers. Already it has been discussed and many times it has been debated. Our freight segment is a core segment which generates a lot of revenue for us. And there's lot of scope at the end user level to create value in the freight segment. Basically, our goods sheds, our terminal facilities, all these facilities need to be addressed when we are creating values. So as an organization, we are a complex organization going into construction business, going into operating business, going into production business, going into maintenance and repair and overhaul business. With such kind of complexity of business, we have to understand what is the value of our different parts, who creates value for us, and who is destroying the value for us. So in lastly, value of parts and sum of values remain key for any finance manager to monitor. So when we are addressing all these questions as a finance manager, to understand the common commotions happening in the organization and outside the organization, what are the possible answers we'll be looking at? First is we have to estimate the key figures of asset and equity. We cannot merely focus on our operating budget or revenue budget or capex for that sake. These figures are important for us to fix a direction for ourselves. Key financial ratios to be fixed and monitored. Third is asset monetization will help in improving asset turnover. Already a lot has been said about asset monetization. Now what is asset monetization? Asset monetization has to be differentiated from the liquidation of assets. What is Air India and BSNL witnessing is liquidation of assets. And what is SBI witnessing is asset monetization. It will be unfair to say that public companies do not get value in the market. If we see today, IRAS was the most subscribed offer in the market. SBI card gave 9 times returns to its investors, which were a foreign investment house. PSEs do have a lot of brand value, and if they create value for the people, people like them a lot. We have to think of generating future cash flows from our land. Recently, I was studying about NHAI going for logistic parks. Even with the paucity of land, NHAI can think of contemplating a logistic park for multimodal transport. And with the railway sitting on a lot of assets, we are still lagging behind. Our land is nothing but a gold mine which we have to dig through future cash flows. Only then we can prevent ourselves from going into the stage of liquidation. And I think we have positive examples present in the market which we can look for. Fourth is entry and exit strategy to be used in project implementation. What we have observed is that we become possessive about ownership. In a country like India, where assets have to be created rapidly and which are highly capital intensive, it is important to rotate the capital. We cannot let a capital be fixed in one project and wait for returns to come over the years and then invest in another project. Therefore, we need to have a clear entry and exit strategy. For example, suppose we have invested in some freight corridor. In that freight corridor, once an investment is done, once the operation is started, if some passive investor who is not interested in management control, and there we should also differentiate that not all investors want management control. In fact, very few investors want management control. They want returns. So if we can bring them in the form of InvITs and exit the project and start another project, then it can be really great. In fact, if we see the NHAI strategy, it has been like that. The one thing which I have liked about NHAI is that they are going into these particular models very rapidly. Fifth is markets are essential for rapid expansion of railway network. We should love markets. Markets are not antagonistic to our interest. In fact, they provide us capital, they provide us more kind of techniques, and we can grow faster with the money provided by the market. In fact, the companies which are listed right now, we may be perceiving that government has sold its stake, which is rightly so. But tomorrow, even these companies, if they want to raise equity for themselves through fresh issues, they can do so. So capital is always welcome, so that you do not miss growth opportunities just because you don't have capital. So what are the things we have to practically do to achieve the goal of asset monetization, future cash flows, and better monitoring of our debt? We have to expedite our accounting reforms. It's an ambitious project and very important project. I feel that it can bring out a lot of figures to the forefront. In fact, there is also a need to debate the assumptions being made in our accounting reforms. For example, as many of you will be aware, our land is being valued at ₹1. Now the intention is correct because we have to book our land. We have to bring our land into the books. So we are trying to just build our books right now. But you can assume that your land is not at ₹1. So the awareness about assumptions, the debate about assumptions is very, very important. Second is continuous experimentation with various business models. Again, we have to draw inspiration from HAI. See TOT, BOT, DBFOT. HAM, what not they have implemented. Let us not get conservative in our approach towards new things, because they are the ones which will bring something cash flows for us. And you never know which one will work for you in totality, because that only long term can tell. Fourthly, building internal capacity on valuations. Valuations are very, very important subject today. We have various methods of valuations, relative valuations like P method, PB, or you have absolute valuations like free cash flows to equity firms. All these valuation methods are very important. I would like to refer here that IRCTC got a lot of commotion in the public circles, because when on the listing day, it got doubled. And today it is almost 3 times the listing price. Government could have garnered much more value through that IPO. But I feel that the valuations, the internal assessment on valuations have to be robust. We cannot outsource everything to transaction advisors like SBI Caps and Yes Securities. We are competent enough, we know our business model, and I don't think that anybody can value our business much better than how we value our business. Lastly, implementing new financial structures like InvIT can get us a lot of resources from the market and rapidly expand our network, which is the need of the hour. Lastly, I would leave all of you with one of the best quotes by Warren Buffett, who says, managers and investors must alike understand that accounting numbers are the beginning, not the end of business valuation. Therefore, we should get our accounting numbers right and unlock and unleash ourselves through a right valuation and creating proper business models. Thank you.
Thank you, sir. It was a wonderful presentation.